The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events.
I'm not betting on the competencies of the PhD priesthood, but rather on the fact that uncertainties in life are a constant, and uncertainties in life are one of the many uncomfortable realities that you must get comfortable with.
Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. Before we start, I just want to invite the listeners to join us this Thursday for the quarterly conference call. That's with Doug Noland. It's the Tactical Short Fund, the one that Doug Noland runs.
We chose as our topic the collapse in global bond yields, and Doug will present a compelling case for the actions required in this environment if you're going to balance risk and reward. You can go to mwealthm.com, register, and submit your questions ahead of time if you'd like for us to look at those questions more thoughtfully versus just off the cuff, and Doug and I will address them this Thursday, July 18th. That's Thursday at 4 p.m. Eastern. So whether you're an existing wealth management client or someone looking to learn from Doug's experience in managing assets through not only sort of the creation of a bubble, but ultimately the bursting phases of the last 3 decades. We've had multiple cycles and bubbles and bursting of bubbles over the last 3.5 decades. Follow the link to register, and we'll look forward to at least providing some entertainment on Thursday afternoon.
For the person who doesn't really understand what they're getting with Doug Noland, I was talking to a listener of the commentary yesterday. He called in for the first time. He had been listening for several years, and he said, I've been reading Doug Noland for 2 decades. He says, that guy's amazing. And how in the world did you guys get Doug working with you? So if you get a chance, you can listen in on Doug and also go to MWealthM to read his weekly credit bubble bulletin. That's free.
Doug represents a skeptic in the world of religious faith and the growth of credit, the infinite growth of credit. And as you might recall, we had a conversation with Tomas Sedlacek a number of years ago, who wrote a very powerful and I think a very important book called The Economics of Good and Evil.
Almost a philosophy book as well as economics.
Tomas is very much philosophically minded. He was the head economic counsel in the new capitalist state in the Czech Republic. So this is under Václav Havel at age 23.
That was after the Velvet Revolution. That was the revolution where no one died.
That's right. And so, what was framed there, at least by Sedlacek, is this idea that credit becomes a matter of faith. It becomes something that people have confidence in as a curative, a cure-all. Again, so I'd see Doug as kind of the skeptic saying, wait a minute. Now, are you saying that you can just create as much of this as possible, as much as you want, and there's no ill effects either to an investment cycle long-term, the stability of a financial system? Tell me there's no impact and I'll have to cry foul. And so the Credit Bubble Bulletin has for 20 years tracked so many of the things that end up looking like, and are in fact, malinvestment, and with real consequences.
Oftentimes, Dave, when I look at the central bankers, I go back to what Tomas Sedlacek called them. He said, in a way, it's the new priesthood. They can control interest rates. They can somewhat control the markets. Last night when you and I were talking about the program, which we do when we meet ahead of time, we were talking about what is interest really? And what interest is, it's a measure of uncertainty. It's a measure of uncertainty. So let's take this next 10 minutes. Well, the next 10 minutes are relatively certain. We're recording a program that we do every week. I have a pretty good idea of what's going to occur. But now if I go an hour out, or a day, or a week, or a year, the uncertainty increases. What interest is? Interest is a measure of uncertainty. Now, these priests, if they can control that uncertainty and make it look like certainty, at that point, they have an amazing amount of power, do they not?
Well, of course. And we have common experience with contingency, things that come up that were unexpected.
Right.
And so the idea that somehow you can have a vision into the future, which includes these future contingent events or circumstances, and you can somehow work past them, include them in your analysis, and have almost a godlike view of what will happen. It really is a fascinating thing to see the priesthood then in ancient Babylon, and even now amongst the central bankers.
One of my passions has been for years is going back and learning what is it that the ancient people knew about astronomy, because you know that I love astronomy. Well, in the last 150 years, there's just been a revolutionary breakthrough as to what the priesthood knew and how they calculated the movements of the stars, even to the point where you can go back and see where they would have likely known something that we call the Star of Bethlehem occurred. But the way the priesthood kept power was they had records of the movement of the planets among the what they called the normal stars, the stars that didn't move. So the planets like Jupiter, Saturn, what have you, they could pre-estimate where those planets would be many years in advance. Sometimes they would do cuneiform texts that went ahead 50 years. But here's the thing, the math was secret, and they kept that secret amongst the families. The kings, whether they were Assyrian or Persian or Babylonian or Medes or Greeks, you had all these changes of regime, but they didn't change what we call the magi, or the guys who actually were measuring that. The central bankers are a lot like that. They can create things in the future with money today and control things. The kings, even look at Trump. I mean, in a way, he is at the mercy of Powell. Look at what Powell did with this interest rate cut insurance.
Well, exactly. And I mean, what's happened is we've created complexity, and perhaps it's unnecessary, but it definitely plays to the advantage of the central banker, and they take the role of the priesthood very seriously.
And they use math, a lot of it.
But it really is as simple as buy low and sell high. And if you want to cut through all of the equations, it is that simple. The world of finance and investing is buy low, sell high. But when you infuse the world with equations and complexity and math that you and I would scratch our heads and say, no, I didn't get a PhD in math or physics, and this is above my pay grade.
So just trust us. We're the priests.
There we go. So I look at Powell. Powell's one of the exceptions there at the Fed, and he's not purely an academic, and yet he's talking about this insurance rate cut, this interest rate cut, which represents insurance. And the language that he used this last week, I think, was important because it tied to global economic concerns. It's fascinating to me because the Fed is overtly involved in being a central bank having influence to the world, not just the United States. It's curious justification for a policy committee which is committed to data-based decisions. And really that data which they've based their decisions to or tied them to is supposed to be domestic. It's supposed to be the mandates of price stability here in the U.S. with U.S. dollars in mind and full employment.
That's hard enough. I mean, even if you kept it domestic, how do you have price stability and full employment? Those are two variables.
But of course, we know that pumping of asset prices has become the third unofficial mandate, and perhaps that's why. Perhaps that is why global economic considerations are at the heart of the next anticipated rate cut. As we get to the end of July, we've got bonds around the world priced for perfection. We've got stocks around the world priced for perfection. And that pricing structure has to be maintained at any cost. So perhaps that is why Powell has said, yep, we need to maintain these levels. And again, it extends to the third unofficial mandate.
Do you think that's why there's such an amazing appetite for government debt right now? Because there's so much purchasing by the central banks they're the main investors right now.
Well, Doug will do a better job on Thursday explaining that and exploring that. But I think if you look at the insanity within the bond markets, particularly in Europe in recent weeks, consider last week, we had demand for nearly 17.5 billion euros in Italian debt.
Yeah,
debt. It's maturing in 2067. That's just a few years out. And the debt offering was for 3 billion euros. So again, multiples of that in demand. 3 billion was raised, but 17.5 billion in demand for that 3 billion.
Give us those Italian bonds, especially for 50 years of uncertainty.
Let it sink in, because it's Italy. Yeah. It's 50-year bond. It's 2.88% yields.
Unbelievable.
And we've got fiscal affairs, which are a mess. You've got monetary affairs, which are a mess. And really, frankly, the monetary side of things is out of their control, the Italians.
So is it the Europeans only that are buying this, or are people coming from around the world to buy this wonderful Italian debt?
in part, but I think you're also looking at pension funds and other groups that would just say, look, 2.8 is positive versus negative.
Wow.
not as in something we can be happy about, but literally it's a rare thing to find these days, a rate that is nominally positive. 80% of the demand for that Italian debt offering came from foreigners.
Mm-hmm.
And I think perhaps they've forgotten that 50 years is a long time to lend money in Italy.
50 years is a long time to lend money to anybody, anywhere.
Yeah, and this is fascinating because, as you may know, I'm getting a chance to chat with Richard Silla. Sidney Homer and Richard Silla wrote the textbook on interest rates.
It's very, very thick.
It's about 700 pages, and I've always used it as a reference tool.
Right.
And now I get to read it page by page, line by line. And actually, to me, it reads like a thriller. That may sound odd, but it really is interesting to see commitments that people make and when they break them and the stress and strain of why they break them. It's a history of war. It's a history of conflict. It's a history of scandals. I mean, when you look at interest rates or you hear the word interest rate, you must think this has got to be like watching paint dry. And yet, it is one of the most interesting and fascinating things that drives.
It's actually the human story. Because if you're measuring uncertainty and you call interest rates the measure of uncertainty, at that point, you'd bring in the human story.
Which, again, inflation is an all too common factor over the amount of time that we're talking about this Italian bond offering.
Right, the devaluation of your currency.
I mean, the thought really is that they must be a member of the eurozone. The inflation risk is not Italian inflation risk. We're not concerned because it's now a continental issue versus a country-specific concern. Or perhaps that this is sort of a free pass reflective of German monetary policy because, of course, the ECB has some German conservatism infused into it. That was the stipulation of creating the ECB, is that there was almost the ethos set by the Germans. And this takes us back, frankly, to the mispricing of risk in that 2006, 2007, 2008 timeframe, where you had massive property development throughout Spain and Italy and what we know as peripheral Europe, and everything was being priced as if it was a German obligation. The quality was confused.
And see, when you interviewed Ottmar Issing, who was actually the first head of the European Central Bank and probably would be called the father of the euro, he knew that there was a problem there because you could unite money into the euro, but do you really make an Italian a European or a Spaniard or, a Briton? Okay, think about it. Look at what we've had with that since then with this Brexit argument. So they have to operate not just monetarily, but fiscally. In other words, when do you stop being an Italian and start being a European?
Right, and that's where the limits have been. The frailty of the euro system is, as it always has been, a monetary policy framework, which is transnational,
right,
transcends borders. It's mixed with a fiscal policy framework that's isolated to each country in the eurozone, and that's a mismatch.
That's just a problem.
So a multi-century look at the Italian lira, and it shows you that there's these routine monetary policy abuses, devaluation, to make up for the fiscal policy largesse, because you've got a fairly volatile voter base. And so you create these popular vote-buying schemes. You abuse the fiscal policy side of things to make those upfront promises. And then rather than implement austerity as time goes on, you just abuse the currency.
Well, and they're not known for austerity. I mean, let's face it. When have the Italians ever used austerity as their means to pay back debt?
It doesn't even fit by personality. So if you had a national personality, which I know is not exactly accurate, but you can borrow and spend today. But if you can't print your own currency, then you're in a real pickle. You will bear the full burden of that debt in the future. And Italy, as you say, it's not a place that approves of austerity, which at the street level, austerity is the experience of a debt burden.
Right.
It means that instead of having extra money to go spend on things that you love, a glass of wine or other things that you may be passionate about, and the Italians are passionate, guess what? You have to redirect that capital to paying debt. How boring, how responsible, how burdensome.
Is the Italian now becoming euro, at least with the way the Italian lira is looked at? Okay, in other words, is it looking more towards the Germans paying Italian debt or the Belgians paying Italian debt?
Well, exactly. In the absence of the lira, you've got the default mode of printing to accommodate the long history of overspending. That's not an option. And I think ultimately, when you're abusing the fiscal side, which the Italians continue to, you're ultimately compromising the viability of the eurozone as a whole. And yet, that's what you're seeing in play. You've got the peripheral European countries. They're borrowing today on terms that reflect someone else's credit quality.
Well, and we have negative interest rates with these government bonds, but corporations, there's a new entry into the negative interest rate market. Corporations are now saying, hey, give us $100, we'll give you 99 back after a period of time.
Yeah, and I love this section of Homer and Scylla's book where they're doing the study of ancient Greece and Rome, and you've got massive risk-taking as you move goods from one part of the world to another. And the interest rates could be very high as a participation in this risky trade venture, right? And there's implicit risk to commerce. There is. But the idea that somehow you can get money for free in the context of commerce where there isn't a risk-taking, there's capital at risk all the time, is absolutely absurd. Bloomberg points this out. The year started, 2019, with no corporations with bonds yielding less than zero. Now there are 14 major corporations in Europe, and
it's the new wave.
Their bonds they trade at less than zero. I mean, what a day when you can raise money, be in essence almost paid interest on the debt you owe versus paying interest on it.
Do you think maybe you could do that for the company? Could we borrow money and expand and not give back what we borrowed?
Well, exactly. But to the borrower, it is better than free money.
Yeah.
So concerns. What concerns? I mean, keep in mind that capital allocation decisions, whether they're your household, my household, this company, a corporation of any size, a government, they are greatly influenced by the scarcity of resources. Mm-hmm. You have to weigh decisions carefully when the capital is scarce. Where you have a problem with malinvestment, it's usually because credit has been plentiful. Malinvestment is the problem of the age because money is free. Credit is available to all. I spoke with a friend recently about a finance problem with a car dealership. A couple walks in. They've had their last 3 cars repossessed. And lo and behold, in the last week or two, this couple qualifies for a loan for a new vehicle. They drive off the lot with a free one. I mean, it's all, literally virtually free to them.
Right.
And it's free money that drives that kind of a cycle. They've got a low credit score. They've had the last 3 of their vehicles repossessed, and they walk on and say, I think we want one of those. It's a great color. Honey, wow. I think you owe it to yourself.
What would you like to drive next for the next 3 months?
And of course, it's going to be repossessed within the year.
Sure.
The dealership doesn't matter. They just moved inventory, right? And it's not on them because they don't hold the risk. Remember what happens when you don't hold the risk.
Right.
We already went down this road with asset-backed securities.
And sell it into funds that have no idea that it's those people who have defaulted on their loan 3 times.
Oh, by the way, it's those funds which are full of yield-seeking, income-hungry investors who just are taking care of, they're scratching one particular itch, which is, got to have income if I'm going to retire. That's it.
When you have an unlimited buyer. Now, I'm going to go back to this priesthood, the priesthood of central banks. If they indeed can print money and then go out and buy bonds, buy whatever asset, are they not crowding out the actual real market? This is why we have, price discovery has gone away. We have no idea what anything should be priced at.
Right. It's just not the role that central bankers are supposed to play or that they have played historically, although that may be redefined in the modern era. Central banks take a seat at the fixed income table. That table is normally reserved for investors, and it forces investors to move elsewhere. So rates, which are typically an indication of things like credit quality and the time frame that money is being lent, and interest rates, again, reflect the place, the geography where money is being lent to, and how deep the market is of buyers and sellers. Is it a healthy two-way market? So why am I surprised? Why am I surprised by this? It practically addles the brain to see this crowding out, where all of a sudden someone who's seeking income goes to the Czech Republic,
right,
to buy bonds,
right,
or short-dated Hungarian bonds, Polish bonds. Think of this. Czech Republic bonds, short-dated Hungarian and Polish bonds are trading in negative territory. Does that sound natural to you? I mean, it doesn't sound natural for the Germans to be trading in negative territory. But when you start saying, yeah, but interest rates are supposed to be an indication of credit quality, I'm not trying to sling mud here. I'm just looking at the historical record. There's more pressure in places, less developed places like the Czech Republic or Hungary. And it's the way of things. I mean, of those 3 countries, you realize one of the worst hyperinflations in recorded history happened in Hungary within the last 100 years.
Right.
Would have been the 1940s. And yet you can buy Hungarian bonds with a history of hyperinflation, and they pay less than zero. So if this is for entertainment value, maybe this is just meant to be an Eastern European comedy show.
Okay, so to put it in perspective, you were talking about the Czech Republic. The United States has the reserve currency of the world and supposedly the largest backbone to pay back their debt because we can just print that currency. Does the Czech Republic really warrant market pricing that's better than U.S. Treasuries? I mean, the United States has to pay more on their treasuries than the Czech Republic. Why is that?
Right. Well, I mean, the whole thing is a little absurd. And again, goes back to that idea of crowding out. The Financial Times is pointing to the fact that you even have a debt rally in Croatia and Kazakhstan, right? So they talk about crowding out. Savers have to find
Give me those Croatian bonds, baby.
How about Kazakhstani bonds?
Yeah.
You know, anytime there's a stan in the name, you travel with a flak jacket, you wear combat boots. I mean, it's a different kind of holiday.
And you buy their negative yielding bonds.
Well, they're not negative yielding, but there is a rally there in their bonds. And again, it's crowding out. It's savers having to find income. It's speculators putting their faith in the power of the priesthood. Mm-hmm. And it's our modern day central bankers trying to direct the course of rates lower. We talked about the $13 trillion in negative yielding paper around the globe. That's what is nominally negative, right? So it just on the face of it. If you factor in inflation and are looking for real inflation adjusted negative yields, you're up to 25 trillion. Right. It doesn't even matter, right? Because 1 trillion, you can hardly wrap your mind around. If it's 25 or 125 or 50, it doesn't matter anymore. And it's on its way to 30 trillion if there are 2 rate cuts here in the U.S. this year.
You know, last week we talked about Trump wanting to join the party, you know, almost like a bunch of frat boys who were trying to go negative rates, lower their currencies. And he's like, let's just jump right in there. But in a way, that is easing pressure on Powell. I mean, you've got these ridiculously dangerous countries that are yielding less than a U.S. Treasury. At that point, doesn't Trump have a point, even though it ruins our currency in the meantime?
Well, so if he takes a dovish posture and is more accommodative, it does put downward pressure on the dollar. Right. Downward pressure on the U.S. dollar creates some relief for the emerging markets. The opposite's true, too. A strong dollar puts negative pressure on their currencies and thus on their debt, particularly dollar-denominated debt. So places like Turkey, where there's tons of dollar-denominated debt, it's excruciating.
But are we creating a bubble? Are we creating a bubble worldwide, not just here in America?
I think our monetary policy, in essence, is fanning the flames to the degree that we are accommodative and dovish. It does put pressure on the U.S. dollar downward and eases up the pressure elsewhere. So I think you could say our monetary policy, in essence, is fanning the flames of a global bond bubble. The real fuel for the bubble is credit growth. Mm-hmm. And credit growth, the biggest contributor there in recent years is China. And I mean, bigger than any other part of the world. So you could argue that without Chinese credit growth, your emerging market economies, your global growth story, in total, you're looking at it being in bad shape. So how far can the Chinese financial system expand its credit? To the degree that it can continue, you might see some hints of, global growth, GDP growth. Without credit growth coming from China, you are talking about a worldwide recession.
And there is a strange irony here because things are not just plummeting. The interest rates aren't just plummeting. They'll plummet and then they'll rise from negative rates a little bit where it's like, oh, are people becoming fearful? We saw that last week in Europe. We're starting to see rates that would be negative. It's not just all in a free fall. They do rise every once in a while when someone possibly gets wind that maybe things aren't fine.
Well, I'd say that they've been in free fall for most of the year. And last week, as we finished the week, was something of an exception for 2019. It was a week of wild volatility in the European government bonds, and perhaps the only reminder thus far in 2019 that rates can rise as well as fall.
So it's a little bit like a body falling off a cliff. Every once in a while it hits, it bounces a little, and then continues to fall.
You're talking about the proverbial dead cat bounce of the market. The bond buyer has been assuming that prices only go higher. And so last week offered up a little bit of a surprise. By the end of the week, you had Greek debt, which is still down an amazing 2 percentage points, 207 basis points year to date. It jumps 21 basis points in a week. That's pretty wild volatility. Portuguese debt still down over 100 basis points. That's over 1% year to date, and it jumps 22 basis points, just under 0.25%. Again, those are big moves within a few days window. I mean, if you saw that stretched out over months or years, no big deal at all. But we've had a collapse in yields, and this bounce was pretty impressive. Spanish debt, same thing, rose 25 basis points. German bunds, which were negative, get this 36 basis points, finished the week at 21. Still negative, but a 15 basis point rally in bunds is a bit of a reversal. French, the equivalent, about a 15 basis point bounce.
Okay, but we talk about crowding out, and it's not just bonds that the central bankers are buying. We talked about last year being a year where central banks bought 74% more gold than they did the year before. They're buying more gold than they did since the late 1960s, before the dollar went off the gold standard. The Chinese rarely report actually the amount of gold that they're buying, but they're talking about the increase in the buying of their gold now.
Yep, Bloomberg covered this last week, and I think this is a contrast, which is fascinating. And it's a mixed message for sure. While on the one hand, you've got massive credit expansion and a rush for yield, some of that safe haven buying, even a lot of it safe haven buying, if you're talking about bunds and treasuries and things like that. You've got governments around the world accumulating gold. June of this year, 10.3 tons purchased, according to Bloomberg, by the Chinese government, following 74 tons purchased in the previous 6 months. So, that's not bad buying. 84.3 tons year to date. And again, the contrast is what's fascinating, because on the one hand, you have a world awash in government credit, central banks the world over aggressively adding to gold. That's what makes it sort of a mixed message.
I wonder, though, Dave, as the reserve currency of the world, again, we were talking about how we're having to pay higher interest than the Czech Republic. The other thing, though, too, is we're really not paying our bills. We're told that we've got a good, booming economy, yet we're spending over $1 trillion more than we're actually bringing in every year. I mean, we're not at war. This is not an emergency situation, as far as I understand.
Yeah, and that's, I think, one of the interesting things in the history of interest rates is you see the fiscal and monetary combined, and as they mash together, ultimately the reserve currency, which has been held by others, whether it's the British or the Spanish or what have you, you see ultimately a crisis, and that crisis, economic in nature, has a lasting political residual effect.
Barry Eichengreen talked about this. He called it exorbitant privilege, but there is also a burden that goes with it.
And I think he looks at it as a burden and argues that the U.S. should give up the U.S. dollar as the world's reserve currency. He's looking for something more fair and even-handed, a basket which is more... And I don't know what his political persuasion is or where his philosophy lies, but I can say that for those that have argued that it's a burden, there is an aspect to which we've benefited as well.
Oh, sure.
And I think one thing that can be said from the historical record is it's not a status that is easily gained or has ever been perpetually sustained.
The ball always gets handed off.
That's right. And so, or fumbled and then picked up. And yet knowing that, what are we doing now? We're adding $1 trillion in new debt each year. Wow. And as you point out, this is in peacetime. We're not in a recession. We're not at war. It's very common to see debt increase dramatically and interest rates as well during periods of tension when you're at war. We don't have an increase in interest rates, but we do have an increase in debt. But it's in peacetime. It's not in a recession.
Oh, and it's amazing how the hackles on people who are absolutely blindly fond of Trump without looking actually at policy, the hackles on the back of their neck rise anytime you say, well, he's not a fiscal conservative.
I think you have to question how objective you are in a conversation or in a debate when you can't engage with the facts. And I see this on left and on the right, where people get angry and they get emotional and they can't have a discussion.
They take sides. It's like they're wearing a jersey of their particular favorite team, and you cannot question anything about the policy.
No, otherwise you're on the chopping block, the loyalty chopping block. But we have a budget deficit that's expanded by $2 trillion under Trump over 2 years. And again, it's like we're expecting fiscal responsibility. I wasn't expecting fiscal responsibility from a guy whose own personal wealth has been increased by the use of debt. But we've got a budget gap of $747 billion here in the first 9 months of the fiscal year. Fiscal year is different than calendar. Keep that in mind. But $747 billion in the fiscal year thus far, we're running at a 23% higher rate over the same time frame in the previous year, 2018. And again, it's just worthy of note. We're spending, but we're not at war. We're not in a recession. Our burn rate overextends us by $1 trillion a year. Ask yourself this question. Can you guess what the deficit number will be when we are in recession? Is it a 2? Is it a 3? Is it a $4 trillion number in fiscal red ink? This is where we are edging closer to the moment of truth with our currency. And this is where, again, it's a confidence game. You get up to it, and right now there's plenty of confidence. But until that moment where confidence is lost, we are strong. But our strength is really not because we're strong in absolute terms. We're strength because of others' weakness.
That's, and that's such a great point. We'll see on the charts that the dollar's rising. What's it rising against? Well, it's rising against other weak currencies. But if we actually saw what the dollar was doing in buying power, everything's falling. The dollar's falling. It's just falling a little slower than some of the other currencies that are out there. I mean, I'm wondering if this is why the accumulation of gold we talked about with China and the central banks.
This is one of the reasons why on our wealth management team, our MAPS portfolio strategies like real things. They're oriented towards real things with cash flow because we see the games being played with currencies in our lifetime. And we are, I think, nearing cusp events that will have a major impact on things like the euro, the yen, the US dollar. And how you price it in any of those currencies is almost irrelevant. That you own something real, that you have a cash flow, and that those things can adjust upward are very, very compelling to me, both from the standpoint of asset preservation, but also locking in an income stream that can grow even under pressure. So,
well, and that keeps you from losing on a relative basis. Okay, if you think you're gaining and actually you're losing every year in buying power, but you think you're gaining, you're still losing. Resources, I mean, let's face it, a loaf of bread is a loaf of bread.
Right. So we're talking about measuring things in absolute values, in absolute terms, and trying to find a variety of plumb lines in a world where measurement has been obscured, if that makes sense.
Right.
So we're strong relative to weaker currencies elsewhere at present, and again, on a relative basis. But in the long run, who cares about relative winning bet if in absolute terms you're still losing? And I think this has already begun to factor in. If you're looking at the buying of gold in the last 2 months, 3 months within the marketplace, it's beginning to factor in. In fact, I think you could stretch that back to 2016, the time frame from then to the present. We put the floor in at 1050 on gold. Gold buying in this period is looking different. I think the perception game is up. It's up for a lot of professional investors.
Did you see Mark Mobius? Mark Mobius, I mean, he's been the genius of the financial markets. You know, he almost has a scientific sci-fi kind of look. You know, the name itself, Mobius Strip. But for 3 decades, I've sort of followed Mark Mobius, and he's never really been a gold bug that I know of.
I think he moonlights for the Blue Man Group, doesn't he? For sure. He's joined the chorus of gold bugs here in recent weeks. And it's not a commodity supply and demand story.
Right.
It's a monetary policy dysfunction story. It's a fiscal policy dysfunction story. It's a political dysfunction story. It's a geopolitical dysfunction story. And the deal here is it's not one country. It's dozens of countries. And now we're talking about a uniformity, which is quite frightening because we're talking about a uniformity of monetary policy dysfunction, fiscal policy dysfunction, political dysfunction, geopolitical dysfunction.
But going back to the priesthood, the expansion of debt is not being created organically. The expansion of debt, not because people want to borrow and create new business. The expansion of debt is artificially being created. And I even look at China, going back to China, in January of this year. You know, we had that scare from September through December with the stock market and the various markets. It looked like rates maybe were going to go up. Powell had talked about 3 rate increases. Remember that? He said there will be 3 rate increases in the next year. And the stock market vomited. and it fell 19 point something percent. And right before it got to 20, which would have been the marker for the officially calling a bear market.
He walks in with prepared notes and says, we're doing something different. We are lowering rates.
Yeah.
And all of a sudden it was almost like a Manchurian Candidate moment. It was like,
it's like back to the party.
Hit the button, man. You got to change the story now.
The Chinese also threw $50 billion into the expanding credit game.
That's right. I mean, so we should not lose track of the fact that the single variable that makes the expansion of debt possible, it would not be possible if not for these artificially suppressed rates. Lower rates allow for an expanded quantity of debt. That's
right, because you're not going to pay any interest on it.
So who's in control of the rates? And this is where, again, the classic view is that the markets control it. And I understand we could be talking about different ends of the yield curve, and now we're talking about central banks versus the markets. But in general, who controls the rates? Are we talking about markets or are we talking about central banks? And we're moving into this era of control where the central bankers want to send a very clear message that it's no longer the markets.
One of the things that we were told a few years ago was all this incredible debt that's out there. And when we intervened, when the Federal Reserve came in and intervened and built their reserves up past $4 trillion, we were told by a central banker that they would sterilize that debt. In other words, they would find a way to keep that from coming to the market. Now, we found that the way they did that was we are paying banks not to lend. We're paying them, what is it, 0.25%, something like that?
Yeah, that was our conversation with Charles Goodhart from the Bank of England.
And he said that we didn't know that that's what he meant at the time.
No problem. We'll just sterilize it.
We'll just sterilize the debt, right?
Is this a social experiment? Are we in Alabama? What are we talking about here? Central bankers are doing what to whom? How is this possible? What?
And they're doing it. Okay, so they can expand this and still somehow create some sort of maintenance without having high inflation. But it's still a tale of artificially enforced rates.
Well, the history of interest rates, it's a tale of market-enforced debt limits, and it's also what's required. It's the necessary inducement made by debtors to keep money and credit flowing. Higher rates draw money out from the mattresses. That's what it has been classically. Higher rates expand the audience of potentially qualified borrowers. Okay. Money starts flowing.
Okay, but here's where I think things are starting to change. You brought up the IMF paper last week, and by golly, if our listeners have not at least downloaded that paper and read the first page,
read the first page.
Do it, because what we're going to see up to this point in our lifetime, Dave, we've been able to invest where we want to invest. There's no stick that's beating us and telling us where we have to stay. At this point, are we seeing the carrot, which is us going out and buying what we think would be advantageous, turning into the stick? And this is what the IMF paper is talking about. It's talking about taking rates negative in the next crisis, maybe dramatically negative, but also that's implied that we would not be able to exit the system. There's the stick.
Jim Grant joins us this next week to discuss Walter Bagehot, the second editor of The Economist magazine, and this was back in the 1860s and 70s. This time frame, there's a number of panics in the market, and you see the Bank of England raise rates from 5-6% to as high as 11% in a short period of time, and they're doing it to make sure that the gold does not flow out of the country. They want to induce capital to stay within the banking system and for lending and credit to continue to flow. They don't want it to seize up. They don't want it to go under the mattresses. So to your point, that was an inducement to stay. That was a carrot. Here is a higher interest rate, and you should be happy with that.
But that's a free market function, too. I can go in and say, all right, well, I'm willing to give up a gold for 11% interest rate.
That's right. But ironically, and we discussed this last week referencing the IMF paper, the past isn't prologue. What has happened in relation to interest rates is not necessarily what's going to happen. It's why the IMF paper is important. Instead of a positive inducement to invest and make money available for higher compensation, that is higher rates, the experimental model we're shifting to is a negative inducement.
The stick.
To see your savings balance, to see them in the system. What they're basically saying is if you're going to try to take it out, we're going to shrink your total capital base. If you're going to keep it idle, we're going to shrink your total capital base. If you're going to put it on the sidelines, we're going to punish you for it. We should gasp. If you want to put it in a mattress of one sort or another, again, we've transitioned to a stick from a carrot, and it's a reminder that times have changed.
You know, you serve on certain boards and foundations, and I know when you're trying to talk to them about the dangers in this environment, it's almost impossible to convince somebody looking at the last 10 years that there's a danger in any paper market?
This is a dangerous market, and it's a tough issue to address because, this particular endowment committee that I'm on, low rate environment, I view as a dangerous one, even though it's been very positive for fixed income portfolios and stocks as well. It's tough because there is a political will to lower rates by policy mandarins, and there is safe haven buying on top of that. What does it argue for? Well, as long as rates are very low, it argues for ever-increasing asset prices, ever-increasing asset prices across the spectrum of asset classes, a bull market and everything, which we've had. And there's this unanswered question, though, in my mind, which is, are the investment markets going to ultimately settle into a crisis environment policy to just be adopted indefinitely? Because that's what this is. We've accommodated. We've been dovish for a very long time. And it does create stability in the short run by trying to address the issue of market uncertainty.
Well, what uncertainty? I mean, the uncertainty has been removed. This is the story of the last decade.
So the issue with uncertainty is this. If you allow for asset prices to diminish, recognize that there's debt associated. This is a system which is so full of debt, you can't think of an asset price separated from some structure of debt that it's related to. And if there is a downgrade or a downshift in the price of a particular asset, it has an implication as collateral on so many loans. So it really is a question of holding together a system of debt by propping up asset prices. And certainty and uncertainty factor into market psychology. If you can remove uncertainty, if uncertainty can be removed from the equation, and again, at its deepest level, this is an epistemic question, a philosophical question, and I don't think you can remove uncertainty.
So the question is, can we truly know the future?
But from a sociological perspective, I think what they're trying to do is make investment on a grander and grander scale with borrowed money by trying to create the perception that uncertainty has been eliminated. And it's a great question. Can you know the future? No. Can we, in some sense, determine the future? This is why we had the conversation we had on the end of theory with our friend Richard Bookstopper, because what he's suggesting is that you can, and again, he's talking about using correlation of events and using big data, you can guide, if not control, outcomes. That's a scary thing to me. It feels very dystopian.
Right.
But if there are models which determine outcomes, then the idea would be that we can remove uncertainty. Just as interest rates have been a measurement of uncertainty, interest rates have been a measurement of the lack of knowledge that we have over time. So the central bankers of our generation are claiming to eliminate that information gap and deliver certainty. That is the message of control. That is the message of central bankers today. It's what I think of as the grand conceit.
You know, we talked about defining interest as the uncertainty of the future, but in a way, interest rates are also a measurement of humility. The higher you have to pay in interest, the more you're basically saying, I don't know and I cannot determine the future. So interest rates are a measure of humility. And so if that's the case and we're negative interest rates right now, what does that say about hubris, pride?
And so these are the central planning models that are, in fact, not only risking the signaling function of pricing in the markets, but they're risking the capitalist system. They're risking the capitalist system we operate in by tinkering with the normal information conveyed in pricing. If negative rates are what central banks consider sort of a comfort zone, if that's what they're saying is going to be a normal state of affairs moving forward, and now depositors have to adjust to a world of zero income from savings, we have a new world. We have a new world where capital accumulation, where investment of that capital is significantly impacted. The foundation of the free markets shifts dramatically when risk and uncertainty are supposedly eliminated. Can it really be eliminated? Practically speaking, in the interim, we have a world where the retirement dream of a generation is on hold.
Yeah.
Why? Because, again, we're moving towards a world where the uncertainty factor has been removed, but the cost is we've lost interest income. And without sufficient income, how do you retire?
Well, and I think of the experiments. You have to take something to an extreme sometimes to see what the ultimate outcome would be. And, I look at the Soviet Union and I look at communist countries that promise really, interest rates are not a factor usually in a communist system because the state controls the certainty of the future. That's just how things go. So there's no humility necessarily because the state controls it. Now you look at the poverty that's caused by socialism and then ultimately communism, which, sorry folks, but communism is just the ultimate extension of what socialism is. And, I'm thinking as you're talking about the destruction of capitalism, how there's probably half of the people who are listening to this commentary, if they just stumbled across it, would say, well, why is that a problem in the first place?
Well, if you think of the risks, let me kind of spell this out a little bit. If you take away uncertainty from the markets and you set a course for asset prices, which is perpetually higher, maybe it's not perpetually higher, but it's at least higher in the short run. The question for investors to consider, again, if you've taken out the risk part of the equation, is how do you maximize profits? If profits are virtually guaranteed, I'm competing with you in the marketplace as an asset manager, and how do I win out?
I'm going to double down.
Well,
I'm going to double down.
So all of a sudden leverage enters in as a distinguishing factor. And so if we've eliminated downside risk and it's all about maximizing profit, then it has to be about stretching the limits of leverage. So yeah, you might say, well, a 2% return on anything is unenticing. But then you lay on 10 times leverage. Well, no one would do that over and over again in a world where there's uncertain outcomes. But if you can give me a guarantee that the market's not going to move against me, then I'm going to leverage up. In a world of controlled outcomes, the temptation to leverage up, that's a real one.
Well, we're the priests of the higher priesthood called the Federal Reserve. In other words, when you have a backstop,
they're telling you there's no downside.
Like the central banks.
Leverage up.
Just leverage up, double down.
Let's be honest. Our guest next week, Jim Grant, will point this out. There in the Victorian period, a period he wrote about while studying the life of Economist magazine editor Walter Bagehot, leverage then as now was critical to taking a small amount of capital and making hefty returns on it. Mm-hmm. Leverage has always been the friend of bankers and speculators. And Bagehot loathed the idea of bank reserves, kind of a rainy day fund for commercial banks. He wanted to see the central bank, he wanted to see the Bank of England foot the responsibility for that.
They backstopped. They were the backstop.
Yeah. And he has some great quips and quotes about how to deal with crisis and the quality of collateral and all this. But the reality is, as a shareholder and operator at Stuckey's Bank, which was one of the larger banks in England at the time, he wanted to see the responsibility of that rainy day fund rest with the central bankers so that banks could be the intermediator for more deposits, for more invested dollars, create more profits on that leveraged capital base. The central bank, and again, this is Bagehot believed, should backstop the entire banking system so that whether you're a small or a Citibank or as Stuckey's was a country bank, you could lend more aggressively with the possibility of insolvency largely removed, or at least the burden of insolvency borne by someone else.
Isn't it strange that the magazine that he became the editor of was The Economist magazine? Now, the very word economy is what you were talking about, scarcity of resources. In a way, when you don't have a scarcity of money, and the scarcity of resources or the scarcity of money is no longer an issue, he's actually an early champion of what you would call moral hazard when there's no real risk, so double down.
To a degree, he was. And it's not that Bagehot didn't have some Victorian sense of responsibility. Lending decisions, when he was at Stuckey's, which is now part of NatWest, when I lived in England, that's where I banked, but they were absorbed years and years and years ago. There's a degree of self-interest here because the lion's share of Bagehot's income came from dividends at Stuckey's. And the dividends got bigger as the bank profits got bigger. And so, again, there's a degree of self-interest here where the direct benefits of higher profitability flow through to shareholders. Walter was one of them. It reminds me of another English gentleman. Every man, as G.K. Chesterton has suggested, has to come to terms with the weakness in the equation.
And what's the weakness in the equation?
I think it's self-interest here. Self-interest drives the ship, whether you're talking about finance and banking or some other subject. And Chesterton asked this question at the beginning of his book titled Everyman. What is wrong with the world? Asked Chesterton. And you open the first page and it says, I am yours truly, G.K. Chesterton.
Okay, so no one's above the temptation of self-interest.
No, he's a good thinker. He's one of the best writers of the period, and yet self-interest factors in, and the weakness within the banking system you could ultimately boil down to self-interest. What is the problem here? We are, or as Chesterton said, I am. So whether it's Bagehot in Victorian England or Jamie Dimon at J.P. Morgan, there are the temptations of leverage based on a removal of uncertain outcomes. That's what the central banks
to do it.
That's right. We now live in an age that would remove the unknowns. Control of the business cycle is a presumptive effort by the central banks to play God, to limit the variables that affect the markets and even consumer behavior.
Okay, so we go back to the ancient priesthood we started talking about.
Yeah, that review of the history of interest rates here in recent weeks, there was an odd fact that stood out. In ancient Greece, the bankers were the priests.
The bankers, really?
The priests were the bankers.
Wow.
And the priests controlled not only money and the stock of savings, but the perceptions that the future could be known if you were close enough to the gods. And of course they were. So the names have changed. So have the priestly robes. Now they're all in pinstripes. But I think the confidence game continues. He who knows the future and removes the uncertainties of the world around us, that person rules the world.
So they're still reading livers in a way to see what's going to happen, and they're letting the kings know how it'll be.
That's right. Now it's a 7-letter acronym. It's not just a liver, and it's not just a simple mathematical equation, although I haven't studied the Babylonian cuneiforms. You have. Maybe it's not as simple in terms of the math. But for my part, I'm not betting on the competencies of the PhD priesthood, but rather on the fact that uncertainties in life are a constant, and uncertainties in life are one of the many uncomfortable realities that you must get comfortable with.
You've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. You can find us at McAlvany.com, McAlvany.com. Or you can call us at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.